Option trading is complicated. Does anybody actually know what implied volatility means? Or is everyone just pretending? That's why I made this video, to tell you everything you need to know about option trading in 5 minutes. What are options? There are two different types of options, a call option and a put option. A call option allows the buyer or the holder the right to buy stock at a certain price up until some point in the future. A put option gives the buyer, the holder, the right to sell stock at a certain price up until sometime in the future. Why would you use that instead of just trading stock? Number one, options give you leverage. Options give you options. Number two, your risk can be totally risk defined using options. So many people have this idea that trading options is a crapshoot, like gambling. In reality, you can use options to completely define your risk while still having major upside potential. Let's talk about what this call option thing is. If you buy a call option, if you own a call option, that gives you the right to buy stock at what is known as the strike price or the exercise price up until a certain time in the future, which is known as the expiration date. Let's say, for instance, we're looking at a stock that trades $150. You think the stock is going up. If you bought 100 shares at $150, that's a $15,000 outlay, a debit that you're going to have to come up with to own that stock. Instead, maybe you could buy a $155 strike call option, which gives you the right to buy stock at $155 up until a time in the future. If you bought 100 shares at $150, that was $15,000. This call option may only cost you $200, $300. However, if the stock went against you, let's say you bought that stock at $150 and it went down to $130, you would lose $20 a share. If you had 100 shares, that would be a $2,000 loss. Now, what is that other thing called a put option? Whereas a call option allows you to buy stock in the future at a certain price, a put option actually allows you to sell stock at a certain price up until a certain time in the future. Let's say it was a $100 stock. You could sell stock at $100. Let's say you sell 100 shares. You collect $10,000, but you have unlimited risk to the upside, because what if the stock, instead of going down, if it goes up to 110, 120, 150, 200, your potential loss is absolutely unlimited. There's this word out there called premium. What does premium mean when we're talking about a call or a put option? Let's say the stock is trading $100 and you would think the stock is going to go up and you want to buy a call option, which allows you to buy stock at 105. Nobody would buy stock at 105 right now. If the stock was trading $100 in the open market, that'd be a $5 loss. But let's say you pay 50 cents or $1 for the right to buy stock at 105. That is known as the premium amount, or the extra amount, the VIG. When you're trading, you're going to hear all about something called in the money, out of the money, at the money. What does that actually mean? I'm going to break it down for you real easily. Let's say you own a call option and the stock is trading 100 and you own the 95 strike call option. That gives you the right to buy stock at 95. That is known as in the money. What is an out of the money option? Same stock trading $100 and you buy the 110 strike call. Right now, that call option is considered out of the money. Then there's this thing called ATM, or at the money. At the money are options which are really close to or right where the stock is trading. So in this example here, if you have a $100 stock, the at the money option would be a $100 call or a $100 put. Now there's this thing called extrinsic and intrinsic value. It's not that difficult, folks. I'm going to make it really easy for you. Stock trading $100. Let's say you buy the 95 strike call. That gives you the right to buy stock at 95. Well, if you think about it, if you can buy stock at 95, sell it at 100, that's worth $5. That's the real value, or what's known as the intrinsic value. But let's say that 95 call option actually costs you $6. You have $5 of intrinsic value, the real value, and that extra $1 is known as the extrinsic value. So many people are so afraid of the term implied volatility. That is the biggest driver of how option prices fluctuate. And just think of it this way. Every product out in the world is priced based on supply and demand. When oil prices go up, why is that? Well, typically it's because supply is down, demand is up. A broker is either a physical person, maybe you have a broker, or an online platform that you use to facilitate your trading. We actually prefer one of two platforms, Thinkorswim, which is on the Charles Schwab platform, or Tasty Trade. One of the biggest things is understanding your risk management. Everyone needs to understand risk management. And like I said earlier, we do not trade options. We do not put on a trade looking to hit a home run. We want to grind things out. So that's why here at Prosper, when we talk to our students, when we explain to our students how to trade, how to appropriately monitor your risk management, we typically use 2 to 3% of your portfolio on any one option trade. A few minutes is not enough time to learn options. Click on this video where you can watch a full 4-hour course on how to trade options for beginners. I look forward to seeing you there.